welcome to this week's episode of Coinscrum Markets. I'm Nisa. Coming up, Efrontier's Andrew Tu talks to us about the markets in crypto RFQ. Dave Hendricks, CEO of Vertalo, joins me to discuss the intersection of DeFi and real-world assets. Joey Krug, Pantera Capital CIO and co-founder of DeFi pioneer Augur, speaks to teana. And James Bennett is back to analyze this week's on-chain data in on-chain reaction. First, a look at this week's blockchain industry news. The New York DFS, regulators of the state's BitLicense, published a green list of 10 crypto assets this week, enabling licensed entities to custody and list them for their approved purpose without prior approval, as well as the leading native assets such as Bitcoin, Litecoin, and ETH. Stablecoins issued by Binance, Gemini, and Paxos were also included on the list. The blockchain industry also received another regulatory boost out of Washington when the Senate voted through a second term as commissioner at the SEC for Hester Peirce, recently reiterating her views, saying crypto is going to be here to stay and that she would like us to set up a regulatory framework that supports it. After telling their clients last month to avoid Bitcoin, Goldman Sachs may be about to throw its hat into the stablecoin ring too. Having recently recruited former JP Morgan head of digital asset strategy, Ali Harris, the firm announced that it is exploring the commercial viability of creating its own fiat-backed token, while also looking at how blockchain technology might help bring efficiencies to other verticals such as the repo and credit markets. This year's growing anecdotal evidence of the institutional adoption of Bitcoin and other crypto assets, especially in the US, is supported by public blockchain data too. Forensics firm Chainalysis released a report showing that transaction values of $1 million or more across a wide range of tokens in the North American region rose to 57% of global share in May this year versus 46% in December 2019. And there was further institutional validation of the asset class this week when NASDAQ-listed business intelligence firm MicroStrategy acquired over 21,000 Bitcoins for an aggregate value of $250 million to include in a basket of alternative assets that it intends to invest in part of its revised capital allocation strategy, citing the Fed's ongoing loose money policy as a key reason for diversifying their significant cash reserves away from the US dollar. Finally, the DeFi sector continued its meteoric surge over the past week, with the total market cap of DeFi-related tokens hitting the $11 billion mark before falling back slightly, and total value locked in DeFi smart contracts reaching around $4.5 billion. The Ethereum network also continues to outstrip Bitcoin's own Lightning network in supporting faster Bitcoin transactions, with wrapped BTC locked on Ethereum protocols now valued at over $250 million versus only $12 million locked on Lightning. Don't forget to click and subscribe to our channel for more updates. Next up, Crypto RFQ. I'm delighted to be joined by Andrew Tu of Efrontier. Hi, Andrew.
Hey, Nisa. Thanks for having me.
Great to have you. Tell us about Efrontier.
Yeah, so we're a cryptocurrency algorithmic trading firm, and we're a liquidity provider as well. So we come from the traditional markets. Our parent company is called Tradomatics. They're an HFT firm based in Tel Aviv. We do around 5 to 10% of the Tel Aviv Stock Exchange options volume. and we trade on a number of venues across the world. Around 3 years ago, we got into crypto, first starting just doing prop, and then we added a market maker division later.
So, and you've been actively involved in DeFi. What are you seeing in the decentralized exchanges right now?
Yeah, I mean, it's been an insane growth, right? I think everyone is kind of all eyes on DeFi right now. That's been probably one of the biggest growth drivers of the year so far. I mean, if we look at the volumes at the beginning of the year versus now, it's probably like a 4 to 8x growth. So, huge growth and also insane speculation, right? And we just mentioned before this chat, we were talking about YAM, and YAM is this insane phenomenon of something that's unaudited, not tested, and just put out by some DeFi folks, right? And they're good folks, but at the same time, it's something completely unaudited. And we have 300, last I checked it was 300, maybe it's risen to like more than $300 million in total lock value. So it's huge growth, but also huge speculation. So, huge risks and huge rewards.
Right. And which DEXs are gaining traction?
Yeah, right now it's pretty much these pool style DEXs. So the big three are Uniswap, Curve, and Balancer. And they're very different than our traditional sort of central limit order book type exchanges that we're used to from the centralized world, right? They're not like the Binances or the OKXs of the world. They don't have an order book. They just have pools or multiple pools. And you pretty much just, if you're a liquidity provider in this situation, you just deposit some capital and you let the sort of function work. And it's pretty much all based on this single function that they have. And the reason why they've attracted so much growth, especially over the course of this year, is what we're seeing right now, which is driving all this craze, which is the liquidity mining and the yield farming, right? Mm-hmm. We're seeing this insane yield that you can get from just depositing some USDC into a pool, and all of a sudden you're making double digit, sometimes even with like Wi-Fi, triple digit yields for certain weeks. So that's been a huge growth driver for the DEX space.
And what are you seeing in terms of like the points of interest on the futures options market?
Yeah, I mean, it's interesting because if you're comparing futures and options versus DEXs, right? Futures and options for Bitcoin specifically were pretty much dead, at least from a volumes perspective, from May until late July. And then all of a sudden they exploded with the Bitcoin price, right? So at the time, I think a lot of, especially retail, but also professional traders were really looking primarily at DeFi during sort of the dead months of Bitcoin price when, the vol was pretty much, gone. And then the vol came back and the derivatives volume it hit all-time highs straight away after that. I think another big thing, a big change has been the growth in the CME though. The growth in the growth of the regulated exchanges, right? Before, a lot of the open interest, a lot of the volume was really concentrated in these sort of semi-regulated or unregulated exchanges like Binance or OKX or these sort of exchanges. I think now though we're seeing more and more, you can call it institutional or professional interest from a lot of times the more traditional firms entering the space. And that is reflected by the growth in especially the CME open interest, which I think is something like 4x of what it was this time last year.
So are you bold enough to make any predictions?
No specific predictions. I think though, if we're looking at the general macro landscape, I think my gut is telling me, look, on the speculative side, everyone's starting to speculate. And the thing is, we really are only having crypto native people speculate right now. I think it's really not retail jumping on board yet. Like if you look at Google Trends and look at Google Trends for Bitcoin right? Compared to 2017, it's still, fractions of what, the search results are, right? So the number of searches are. So I think really retail hasn't truly entered the space yet. So on the speculative side, I think we're really just in the beginning.
Well, great. Let's watch this space closely. We definitely have to account for the risks involved and regulation and make sure that everybody's safe out there. So thanks so much for joining us, Andrew.
Yeah, thanks for having me, Nisa.
Dave Hendricks is the CEO and founder of Vertalo, a B2B SaaS platform that connects and enables the DeFi and digital asset ecosystems. Dave is a longtime entrepreneur who's been building companies in the data and messaging sectors for more than 2 decades. Today, we'll discuss why he and his 2 partners founded Vertalo and how the worlds of digital securities are merging with DeFi. Today, I'm delighted to be with Dave Hendricks. Thank you so much for joining, Dave.
Great to be here, Nisa. Great to see you as always.
As always, and I'm a longtime board member, full disclosure.
Love it.
So why did you start Vertalo?
Well, Vertalo came out originally of Series X, the company that we started in 2017. We had built a platform for due diligence between organizations and their associates. And in July 2017, we released that platform to my last company. It was a due diligence application, kind of a 2-sided marketplace. The interesting thing was that we used smart contracts to connect organizations with their associates. So we released that in July 2017, and this is, when a lot of companies were starting to look at non-dilutive ICOs as ways to raise funding. So in September 2017, we put together a white paper and a yellow paper, kind of outlining this platform and how we use smart contracts for it. And we started working through the idea of running an ICO. Well, we took this idea to our lawyers and to our co-founder and general counsel, Gautam Gujral. And he looked at it in his hotel room, and he came back the next morning and he said, I'm a securities lawyer, I'm ex-SEC. This doesn't look like something that we should run, but let's talk to the lawyers. So we went and we spoke to Lowenstein Sandler, our law firm. They said, yeah, this ICOs are challenging. So in October of 2017, we decided to do a security token offering, a Reg D security token offering. And in March of 2018, we issued this Reg D, Reg S to 53 holders, in a very, very early STO. It was a real challenge to do this. And the one thing which really struck us was the process of transferring the tokens from a multi-sig wallet to all of our 53 holders, error-free, flawlessly, by hand, took about 9 hours. It was very complex to do it, and we thought, okay, that's a problem, getting shares to holders, in a very easy fashion. But the real problem that we saw was that there was no place to track the ownership of those digital equities, those digital shares on the market. We saw issuance platforms that could create tokens, and we saw exchanges and ATSs that were being created to trade them. And these are artifacts that came over from the ICO era. I mean, those still exist now, firms that write a token for you and firms that trade tokens. What we didn't see was the missing part in the middle. And the missing part in the middle was a shareholder registry, like a cap table. If you were going to issue equities on chain, you're not going to be able to manage them in a spreadsheet. You can't use tools like Carta or these other cap table platforms to manage that ownership because it's in a wallet. It's not a certificate. And we had built a rudimentary version of this for ourselves. So coming out of that issuance in March, I fell in love with the problem that we had found and solved in a rudimentary fashion for ourselves. So in May of 2018, I pivoted the company. And I said, we're not going to do this old kind of HR diligence application. We're going to focus on building a transfer agent, cap table, and shareholder registry for digital assets. And that's kind of how we pivoted and got into the Vertalo that you might be familiar with today.
So some people say that we'll know when blockchain technologies have reached their potential when most users are using it without realizing it. How much emphasis do you place on that thinking in your build out, and how critical are partnerships versus building in-house?
Well, that's a great question. We were not blockchain native. We thought blockchain was a really good technology, a super slow database, but really good for certain things. And so, we hadn't been trading in and out of wallets ourselves. And so we saw the wallets first as a problem for mainstream investors. So once we built this, the first thing that we started to do was to try to tame the wallet problem. And the reason why I said tame the wallet problem was we thought that unless we could tame the wallet problem, no security token offering or digital equity sale would appeal to normals. So we started working with a custodian, a big one, in September 2018 to kind of start fixing the wallet problem, to make it easier for an investor to manage a wallet and to bring a wallet to a capital formation event. But making MetaMask easier to use wasn't enough. So in May of 2019, we introduced keyless custodial wallets. Our feeling was that keyless custodial wallets look most like E-Trade or Coinbase, and that if you want to reduce the complexity and the barriers and the obstacles to adoption of digital equities, programmable assets, what you have to do is you first have to get the nerd stuff out of the equation. And the nerdiest thing in crypto or blockchain is definitely the wallet. Managing private keys, passphrases, using MetaMask and these other things, which just, people don't want to bother with it and they're scared to self-custody.
Right.
So we first simplified that. That was kind of one of our signal, innovations within our platform. Of course, Coinbase had been doing that already. And I really attribute the simplicity of Coinbase as an inspiration for our own platform. Because look, they have 30, 40 million people on their platform who don't know what a wallet is and don't know what a token looks like. They're just buying the underlying asset. So we thought, first, you got to get rid of the complexity of wallets. Mm-hmm. The next thing that we saw, which was complex and expensive, was the production of the token itself. We initially, our plan was to onboard tokens produced by so-called token issuance platforms. And once we saw that none of them had built or were building data management platforms like we were to manage digital assets in a shareholder registry. And so we expected that we were going to onboard the tokens produced by these companies. But we took a look at how much they were charging for this service, and we thought, wow, here's a really great business opportunity. So the wallets solved a complexity problem for the investor. We then wanted to solve a complexity and cost problem for the issuer as well. So in the summer of 2019, we introduced 3-click tokenization. What this did was it enabled any issuer, regardless of whether they're raising money now or whether they had a seasoned asset already or whatever the state of their company was in, to onboard data onto our platform in the form of a cap table or a registry of shareholders. And then with 3 clicks, turn that into a token. And we wanted to demystify the tokenization process we also wanted to reduce the cost, because where wallets are an impediment and an obstacle for mainstream investor adoption, the cost of tokenization is the real impediment in many ways to mainstream issuer adoption.
And so now we're starting to see really many more token issuances, and especially in real estate. And I know that you're focusing there as well. Talk a little bit about what we can expect to see now in security token offerings.
We created a division called Vertalo Real Estate during COVID. I found a team in Philadelphia called Advantage Blockchain. We did an hire of that team that went into effect in June. We found a president for Vertalo Real Estate who's been running his own real estate investment funds for 30 years, and it was a prop tech entrepreneur, Gary Brandeis. He's running that division for us in Pennsylvania. And now they're signing a lot of deals. This week, we're going to add a new client. It's called Mount X. They are in Mexico and in Canada. And Mount X is bringing on at least 15 properties onto Vertalo and tokenizing those. We have another real estate project. It's a Reg A Plus. It's a $100 million Reg A Plus offering, it's multifamily assets in the Northeast. I'll announce that one shortly, and that one's coming on. And every day we have more real estate companies calling us and saying, hey, how can we use this technology to reduce costs for fund administration, but also improve liquidity for our investors?
And you recently wrote about the employee stock option plans, which you have experience with as well. Talk a little bit more about that.
There are a lot of problems with ESOPs. First of all, recording the ESOP transaction at the company is very expensive. Often you'll get granted shares, they won't get properly recorded, and you won't know until much later that you actually didn't get the grant that you want. Employees have trouble tracking them because they don't have access to the cap table, because for 80% of companies it's managed on a spreadsheet somewhere, so they have no idea whether they own them. And then if you actually do own them and your company's doing well, the process of selling them is very expensive, both for the company, costs hundreds of dollars, if not $1,000 for a company to do the legal work to enable you to sell your options. And because it's a peer-to-peer, fundamentally a peer-to-peer market, there's not a marketplace. And so finding a marketplace for options for other than the top 50 startups is impossible. And so what we believe is that if you can digitize and tokenize employee equity in the form of options, and then have a secondary market, maybe a shares post kind of market, where you can then offer your options for sale with a cashless exercise, that perhaps employee options might become something that are life-changing for employees. Today, for most employees, employee stock options are cherry on the top, and if their company doesn't go public or get acquired, there's not much to do with them. And a lot of employees work for years in a company and then walk away from options.
So we're talking about all the benefits here. We're talking about transparency, automation, and liquidity. And we've seen a slow rise in liquidity in this market, but we've seen a very fast rise in DeFi. Yeah. And it's looking for real world assets as collateral in these liquidity pools is an area that Vertalo can master. So talk a little bit more about that.
There's a whole world of assets which are illiquid today, such as real estate and other cash flowing instruments, where no market exists. There's not a borrowing and lending market. There's not really a selling market. And there are these pools of owned assets which are ideal to be pledged as collateral to underpin and support DeFi markets and provide liquidity. Vertalo's plan is to enable asset owners, real estate funds, real estate investors, people who own debt instruments, to bring those assets onto the Vertalo platform, and then in a couple of clicks, turn them into a tokenized asset which can be pledged as collateral on DeFi networks. What this does is that it enables someone who owns an asset not to sell it, but to borrow against it without having to work through a bank or through the other kind of costly procedures that they have to today. And then to use the capital that they get from that borrowing event to go do other things with their business, maybe invest further in their business or more. Today, there's an interesting proposal on MakerDAO, which you can look up on RWA. We believe that in Q4, real-world assets will come into DeFi and broaden DeFi out far beyond its current constrained market of cryptocurrencies. And this will give investors the opportunity to lend against these real-world assets and get high rates of return, mid to high single-digit interest payments. It'll allow asset owners to pledge their assets and get capital in return without having to enter into a tax event like you would if you sold the asset.
Very exciting. And we'd love to have you back to talk about what else is on the horizon for Vertalo in the rest of 2020 and 2021. And we thank you so much for being with us today, Dave.
Thanks a lot, Nisa. Talk soon, and everyone have a great day.
With the hype surrounding DeFi seemingly being a recent phenomenon, it's easy to forget that the concept pre-existed Ethereum itself. One of the earliest projects to experiment with these ideas was founded way back in 2014 when Joey Krug and his then co-founders hatched their designs for Augur, the first decentralized prediction market. With a recent upgrade released and now sitting in his role at Co-CIO at Pantera Capital, Joey joined Teana this week to share his thoughts on the market from both sides of the fence.
Thanks, Nisa. I'm delighted to be joined today by Joey Krug from Pantera Capital. Hey, Joey, thanks for joining us.
Hey, thanks for having me.
That's a pleasure. So given the crescendo of hype around building something around something called DeFi, you must be a little like, oh, been there, done that. So for our viewers who might not be aware, can you give us a little bit of your early history into the foray of decentralized finance that started back in 2014 with Augur?
Sure. Yeah, so I got into the Ethereum space, I'd say, in 2014. Initially I was building this thing called Augur. And the idea was to build a peer-to-peer prediction market, or basically a betting market, where there was no counterparty who processed your bets. There was no one person who controlled all the funds, that sort of thing. And we were trying to build it on Bitcoin. And it was just we would have had to modify a ton of things about Bitcoin and basically fork it to do anything. And so, we came across Ethereum and started building it there. And that was kind of like how I sort of first got into DeFi. There wasn't a lot on Ethereum at the time. It was sort of just us and MakerDAO.
Yeah. Well, and for those who've been experimenting with and trying to build on Bitcoin's original foundation in the early days, it seems like some of those earlier solutions, perhaps started a bit too early and just lacked the benefit of the, innovations that came later in the infrastructure. So, Augur has stayed the course and indeed had a recent upgrade. So, along this journey, what were the most important lessons that you and Augur and the team have learned?
Yeah, I think most of it surrounds, things about building on kind of nascent infrastructure. So when we started building on Ethereum, we wrote Augur in this programming language called Serpent. And that language actually ended up being deprecated. So no one uses Serpent. Almost nobody's heard of it anymore. And now everyone uses this language called Solidity. But when we started, Solidity didn't exist. And so like at one point we had to rewrite our entire code base from Serpent to Solidity. And so, if you look at how early stuff is, I think that there's like a lot of things that we've learned there about like how to build effectively on new infrastructure. Maybe you would build something smaller first because there's a good chance you will have to just rewrite the whole thing. Stuff like that.
Yeah. Well, and I think there's, a fair amount of people that, argue around, is it the market or is it the technology that drives some of this innovation forward? And that, the traditional financial market infrastructure can't be solved with technology alone, and that, technology itself isn't the issue. But in the example you just gave, it was a pretty significant issue. So, how many people in the industry do you think have taken this technology first approach? And do you think that, wider, thinking about DeFi on a wider scale, are there just too many solutions looking for a problem, or are all of these ideas that are being explored, have intrinsic value?
Yeah, I mean, I think I think if you look at why a lot of these solutions don't necessarily solve a problem per se for the end user, I think a lot of it comes back to the fact that it's really hard to paper over the user experience of building on something like Ethereum. Yeah. And so if you look at who they provide value for today, it's mostly people who already own Ether. Like if you look at the transaction costs to do something on Ethereum, as of this morning, it's around 200 Gwei, which means to send money from one person to another, it's like $10. An Augur trade would be like $90 or $100. And so the main use cases right now are just people speculating on other stuff within crypto. And I think to get out of that and to build stuff that people want to use outside of that, the costs need to come down a lot, and it needs to be much faster to use. People aren't going to be comfortable waiting 5 to 10 minutes for a transaction to go through. They'll want to sort of see it instantly. And so I think, or within a few seconds. And so those are, I think, the big problems. Even once you solve those, there's still going to be a lot of stuff built that isn't really solving a problem that anybody has, but that's fine. That's sort of how all tech startups work. If people were perfect about predicting which ones would solve a problem and which wouldn't, VC portfolios wouldn't have like a 80 to 90% failure rate.
Yeah. So sticking with that technology topic, oracles are services that are designed to feed external information into blockchains for interpretation have become a hot topic recently, with projects like Chainlink and Band receiving a lot of attention. And so, these are also the latest iterations of earlier examples. And this is an era that Augur looked to address from its very beginning. So what are your thoughts on the current hype around these projects? Or, maybe not specifically these projects, but projects like these. Mm-hmm. And is collating and reliably distributing information in this way actually viable?
Yeah, so I think for the Oracle problem, it's really a tough problem, and the main criteria that surrounds the problem is how fast do you need the data. If you don't need the data, at a very, very high frequency, things like Augur really are the sort of best solution for that. If you need some piece of data on the scale of days, for instance. Mm-hmm. But if you need some data that's updated every 5 minutes. Today you pretty much have to use something like Chainlink, or you can kind of like do it yourself, I guess, which is sort of what Compound's done. You can get a group of people to provide the results and take like the median of them or whatever, which is essentially what MakerDAO does. But they sort of all converge to a very similar system. I think the problem with all those approaches is that unless you do something beyond that, it's not very secure. Like from an economic standpoint, it's not very secure. The incentives aren't really that aligned. There are like theoretical improvements you could do to fix that though. Like there's a couple papers published by one of the like technical advisors to Chainlink or whatever that talk about provably getting data from a website, and proving that you didn't modify the data sort of en route before you submit that on chain. And like if somebody or Chainlink themselves were to launch that functionality, you would get pretty close to solving the problem. But there's one last problem with the Oracle problem, which is that websites themselves are not necessarily reliable. So for instance, the site may be down, it may be providing a faulty result. This is something that you may think is not that prevalent, but like when you look at like Augur markets, for instance, there have been some where like somebody said, what's the price of 0x according to Yahoo Finance, which you would think is like decently reliable. But it's like down a lot of the time, or even worse than down, providing actually incorrect data. Yeah. And so I think it's a tough problem.
Well, so, and then there's always that question around, the tech being replacing the human, right? And is there, a possibility that this could be gamed without some kind of human moderation?
Right. I think I think it is. I think there's like one way to prevent it from being gamed, which is like you have sources that are like sort of whitelisted, where like you can only use certain sources. I think if you allow anyone to submit a source, it can be gamed, because the problem is you either have to like take sort of a median of the results and penalize people who were wrong. But the problem is if the source itself is telling you lies. Like say I have a source that it's like a random Russian roulette where I ping it, it gives me the result 42. You ping it, gives you the result 47. And the person down the street pings it. Yeah. And it's just like, so we would get penalized even though we did nothing wrong. So the solution people have today as well, we'll just not penalize people. But that's not secure from a different standpoint. And so it's like, it's this really weird catch-22 where there is no like great solution, and I don't think anybody has like a perfect solution to this problem.
Okay. Well, so these days you're now the Co-CIO at one of the most established blockchain-focused VCs in the space, Pantera Capital. Tell us a little bit about that. How did you end up in that role?
Yeah, so I ended up at Pantera. Let's see. So I've been doing a good amount of like angel investing in the San Francisco Bay Area, kind of in late 2015, early 2016, and with one of my friends, he built this angel syndicate where we would basically just do deals in companies that we were friends with or that we thought were interesting. I had also started advising a few companies, particularly in the crypto space. And I ended up meeting Pantera through, so 0x, the decentralized exchange project. I wrote one of the very first checks into that company. And I introduced them to other VCs in the space. And one of them was Pantera. And after that, they sort of reached out and mentioned that they were looking to sort of launch these couple new funds and were looking to bring on a technical partner. And I thought that was interesting. And I sort of knew that a lot of infrastructure and things needed to be funded for this space to actually work. And so I was excited about that. And I also enjoy investing. I like working with companies. It's something I think is pretty fun.
Yeah. So you previously kind of been on the other side of the fence. What insight do you think, having previously been, a crypto pioneer and an investee, has given you in turning into being an investor?
Yeah, I think it mainly surrounds like things that you would come across building a company that are sort of classic mistakes people make, but having sort of been there to help founders and entrepreneurs kind of avoid those mistakes is one of them. I'd say a lot of the advice that I provide to founders surrounds things like hiring, how to run a proper hiring process, how do you hire engineers effectively. I've noticed that a lot of founders feel overwhelmed about hiring, and I sort of did as well when I first started doing anything. But then, at this point, like hiring is not something I get overwhelmed about. It's sort of like, yeah, you can do that. Like there's a process you can run around it. It's not really that hard. But that's like one big thing founders think is really difficult. And then also just like more general kind of strategy stuff, whether it's like a token project who wants help on thinking through certain economic incentives of the thing that they're designing, or really sort of anything. But I think my advice sort of centers around the fact that I've sort of been an operator building stuff in this space in the past.
Yeah.
Also just surrounding like quirks in crypto, like, hey, like that thing that you want to build on that looks great on paper, like actually, I've tried to build on that in the past and it's not as far along as you think. Maybe you should try looking at this thing instead. There's a lot of that in the scalability space, for instance.
Yeah. Yeah. So what projects and verticals are you paying the most attention to now? People ask me about, trends, what's next, what's important. And I always say it's really difficult to separate the hype from a legitimate trend, right? So
right.
What are you excited about at the moment?
Yeah, I mean, at the moment, I think I'm excited about the growth in decentralized exchange volumes. I think that's something that, there's hype right now, but it's going to become a longer term sustainable trend. I think that continues to grow. I think, peer-to-peer lending protocols, I think, are interesting as well. Stuff like Compound, obviously a lot of the high numbers right now are due to the fact that you can earn comp. But I think, a lot of it is actually just legitimate demand as well. So stuff like that, I think, is very interesting. And then I guess the last thing I'm excited about is I'm excited to see some of these like sort of options and derivatives protocols and stuff go live. Basically, I think all these sort of interesting DeFi applications are things that I've been interested sort of the whole time.
Yeah.
And a lot of them are finally starting to go live.
Well, so knowing what you know now, from founding a company, building a platform, launching products, now being an investor and an advisor, if you were going to go back and do it all over again, and start a new project, what would it be?
I think if I were to do it over again, I'd probably do stuff that's simpler, that like new, that I knew would be very easy to make work. And then eventually, once the space had kind of had more solid infrastructure and was much easier to build on, then I would build, the complicated, interesting thing that I really kind of wanted to build. But I think in the crypto space, there's been a lot of low hanging fruit over the years where it's been like, very, very, very easy to build that low hanging fruit, and much more rapid to experiment. And it's stuff that like makes sense to build on Ethereum today. So I think if you look at kind of like in the past, I've built stuff where it needs Ethereum to scale to really work. And back in 2014, everybody, including Vitalik, thought Ethereum would be scalable in 2 years, and including myself, we thought that. Like we thought, oh, it's not that hard of a problem. We'll launch proof of stake and then we'll be doing 1,000 TPS, maybe not 1,000, but a few hundred. It was like, that was like in the bag almost. People thought that was going to happen. Mm. And it's finally starting to happen, but we're now 5 or 6 years later.
Yeah, it wasn't 2 years, right? Yeah.
Right.
Well, it's been fascinating having this chat with you. I've really enjoyed it. Thank you so much for joining us. If people want to get in touch with you and learn more about what you're doing at Pantera, or indeed anything else about what we've talked about, how can they do that?
Yeah, so the simplest ways out there are Twitter and email. So my Twitter is just at Joey Krug. And then my email is joeykrug@gmail.com.
Awesome. Thank you, Joey. It was a pleasure.
Yeah, thanks for having me.
Sure. Back to you, Nisa.
Thanks, Tina. Next up, James Bennett is back for this week's On-Chain Reaction.
Thanks, Nisa. It's been a really exciting week again for Bitcoin now that we've broken that long-term downtrend that we started in 2018. Bitcoin currently sits a little bit below 12K. Now, looking at the Byte-Tree network demand model, which I introduced a few weeks ago, we can see that we're currently on a score of 5 out of 6. Now, remember, the Byte-Tree network demand set looks at 6 different indicators of the network demand. When we have more than 4 of those on, the market is bullish, and if there's less than 4, then we're bearish. So we've been bullish for the last couple of weeks. We're currently at a 5 out of 6 as Bitcoin continues to push upwards. So as Bitcoin continues to push upwards, the valuation actually is holding steady. And this is a factor of the growth in settlement volume that we've seen on chain. So on this chart here, we can see the grey line underneath is the network value to transaction ratio. This is the equivalent to a price to sales ratio for the network. So what we're saying here is that the sales, or the sort of value that's being generated by the network through the increase in settlement volume, is increasing faster than the market price. And you can see there on the far right of the graph that there's a divergence between the NVT on the 5-week time frame and the price, which is really positive. You know, price is rising, but we're not getting too overvalued because it is substantiated by network demand, and network demand drives value. Now, as price has surged upwards, we can see that volatility measured over 30-day period and annualized has hit 40%. That's off a low earlier this year of 18% and a high back in March of 140%. The line on top represents the velocity of Bitcoins. That's the speed that they're moving through the network. We can see that velocity picks up prior to price volatility, suggesting that there's an on-chain movement as coins go to liquidity venues before then being entered into the order book and creating that volatility in the exchange traded price. Volatility is often good for traders, and we've been waiting for this breakout in volatility for the last few weeks. Unfortunately, it's broken to the upside. Moving into the last slide, we can look here at the total revenues generated by miners. So the bars along the bottom represent the total revenues, which, remember, are made up of fees for entering transactions onto the network and the block reward, which miners are rewarded for mining new blocks. The dotted line in the middle represents the halving, and we can see that at that period the total revenues generated were essentially halved, since the coin base, or the block reward, made up a significant portion of revenues. Shortly after the halving, as we've touched on before, the fees made up a much larger percentage as the block times dropped, and this created congestion on the network. But fast forwarding to today, we can see that there's this uptrend has continued where fees are making up a bigger percentage of total revenues. So fees remain high, but that's allowing these revenues for miners to climb back towards the levels that we saw pre-halving. So pre-halving, miners were generating around $18 million per day in revenues, but sometimes that was only 1 or 2% of that was made up in fees. As you can see, the left-hand side of the chart, that blue line is relatively low, close to zero. What's happened in the last couple of months is that fees have increased in absolute terms, increased as a percentage of total revenue generated, and driven those revenues from a low of around $6 million a day up back to about 12, pushing even $13 million a day. So they're moving back towards those pre-halving levels, which is really positive for the industry. It's positive for the network, and it bolsters the security of transactions that are going onto the network. Remember, we need miners to be able to generate good revenues, since they're an integral part of this Bitcoin network and the blockchain ecosystem. So that's all from me this week. Back to you, Nisa.
Thanks, James. You've been watching Coinscrum Markets. Thanks for joining us. See you again next week.